All right, traders, welcome back. You know how we do things here. We take something interesting, something maybe a bit complex, and we deep dive into it. And today is no different.
That's right.
So strap yourselves in as we unpack a popular day trading strategy. It's called the London Breakout Strategy. Now, full disclosure, we're basing this deep dive on a guide, Trading the London Breakout Strategy, by an expert named Jacques.
Sounds good.
But before we get ahead of ourselves, let's make sure we're all on the same page. Day trading. Buying and selling assets within a single trading day. It's fast-paced, it's risky, but for some, it's the name of the game. And what's particularly interesting about this London Breakout Strategy is how it uses the, shall we say, the relative calm of one trading session to, well, potentially capitalize on the frenzy of another.
Exactly.
So let's talk about this calm before the storm. Why is the London session such a big deal in the world of Forex anyway?
Well, you see, the London session is like the main event for Forex trading. It's the most liquid, meaning there are tons of buyers and sellers, which leads to, more price movement. And when it overlaps with the New York session, forget about it.
Ah, New York, the city that never sleeps. And apparently, neither does its trading floor.
Right. It's like rush hour on Wall Street. Everyone's trying to get their orders in. Prices are bouncing all over the place. And that volatility, well, that's where the opportunity lies, especially with a strategy like this.
So if the London session is the bustling city center, is the Asian session like, say, the quiet suburbs?
You could say that. It's definitely less hectic. And that's exactly what the London Breakout Strategy is designed to exploit.
Okay, so walk me through it. How does a trader actually use this strategy step by step?
Okay, picture this. It's the Asian trading session. Things are relatively quiet, right? Well, during this time, savvy traders are watching a particular currency pair. They're watching how it's moving, how it's behaving within a certain price range.
So they're like scouts, gathering intel before the big battle.
Precisely. They're looking for patterns, waiting for that telltale sign, the breakout, and then bam, the London session opens, things start heating up, and suddenly, boom, the price breaks out of that range it's been stuck in.
Like a coiled spring suddenly released.
Huh?
Okay, but hold on. How do they know if it's a real breakout or just a false alarm?
Great question. That's where experience and analysis come into play. You see, a real breakout typically happens with increased volume and momentum. It's not just a little blip, it's a decisive move. And that's the signal.
The signal to strike. So what happens next?
Well, it depends on the direction of the breakout. If the price breaks above the high of that Asian session range, it signals a potential uptrend. And that's when a trader might go long, buying the currency pair in anticipation of further upward movement.
Right, riding the wave as it crests. And what if it breaks below the low of the range?
Then we might be looking at a downtrend, and that's where shorting comes in. It's a bit more complex, but basically the trader is selling the currency pair, betting that the price will continue to drop.
Got it. Buy low, sell high. Or in this case, sell high, buy lower.
Exactly. But of course, there's always risk. What if you misread the signals?
That's what I was thinking. This all sounds a bit like, well, gambling. How do traders protect themselves from, let's say, a nasty surprise?
The million-dollar question. Risk management is the name of the game here. That's where tools like stop loss and take profit orders become absolutely crucial. They're like your safety net.
Okay, I'm intrigued. Break it down for me. Stop loss, take profit. What are we talking about?
All right, imagine this. You've entered a trade based on a breakout. You're feeling good, but, the market can be unpredictable. A stop-loss order basically tells your broker, hey, if the price drops to this specific level, sell my position automatically.
So it limits your potential losses, like cutting your losses before things get out of hand.
Exactly. And on the flip side, you have the take profit order. It's like setting a target, tells your broker, if the price reaches this level, sell my position, lock in those profits.
So it's like saying, hey, I'm happy with this gain, let's cash out. I like it. But still, it seems like there are a lot of things that could go wrong. Are there any red flags, any signs that might make a trader think twice about using this strategy?
Absolutely. This isn't a magic bullet. It's important to remember that the London Breakout Strategy relies on volatility and trends. If the market is flat or moving sideways, it's not going to work. It needs that clear direction, that momentum.
Right, like trying to surf on a calm lake. Not going to happen.
Yeah.
But what about external factors? What if something unexpected happens, like a major economic announcement right in the middle of the Asian session?
That's why backtesting is so crucial. It's like running simulations. You take historical data and see how the strategy would have performed in the past. Did it work? Did it fail? Why?
So it's about learning from the past to prepare for the future.
Smart. But, it strikes me that this kind of trading takes a certain kind of personality. It's not for everyone, right? Oh, absolutely. It's as much about psychology as it is about analysis. You need discipline. You need patience. You need the ability to control your emotions, especially when things get a bit, shall we say, heated.
Right, because if you panic and make impulsive
It
decisions,
could be disastrous.
so it's like mastering the strategy is one thing, but mastering yourself, your own mindset, that's the real challenge. All right, before we let our listeners go, could you sum up the key takeaways of the London Breakout Strategy, just so it's crystal clear?
Absolutely. The London Breakout Strategy is all about identifying a range during the Asian session, watching for a decisive break during the London session, and then taking a long or short position based on the direction of that break. But, and this is crucial, you manage your risk with stop loss and take profit orders.
Beautifully put. And remember, this strategy works best in a volatile market where there are clear trends. Backtesting is key, and so is that emotional discipline we were talking about. Now, before we sign off, one final question for our listeners to ponder. Do you think this strategy, with some tweaks, some adaptations, could be applied to other trading sessions, other markets even? Something to think about.
It really is, because at its core, it's about observing patterns, managing risk, and understanding the dynamics of the market. Those principles are universal.
And that's what makes trading so fascinating, isn't it? The constant learning, the adaptability. Well, folks, that's a wrap for this deep dive. We hope you found it insightful. And as always, remember to keep exploring, keep learning, but most importantly, trade responsibly.